Are life insurance death benefits taxable upon payout? Imagine your loved ones receiving a financial gift that helps them during a tough time. That's what a life insurance death benefit is meant to do. But you might wonder, does the government take a cut when the money is paid out? Let's explore how taxes work with these benefits. When someone passes away and their beneficiary receives the death benefit, they usually get the full amount without paying federal income taxes. This is one of the main reasons many choose life insurance. The payout is not considered part of the beneficiary's gross income, so they do not need to report it on their tax return. It also isn't subject to inheritance taxes in most cases. If the policy is part of an employer-provided group life insurance plan, there is a small exception. Benefits up to $50,000 are tax-free. Any amount over that might be taxed as income to the employee. So, if the death benefit is larger, the excess could be taxable. However, there are some situations where taxes can come into play. If the beneficiary opts to receive the death benefit in installments instead of a lump sum, the insurance company often puts the money into an interest-bearing account. While the principal remains tax-free, any interest earned is taxable as regular income. For example, if a $500,000 benefit earns 10% interest over a year, the beneficiary would need to pay taxes on the $50,000 in interest. They report this interest using tax forms like 109 and 109 and 1/2. Another factor to consider is estate taxes. If the death benefit is paid to the deceased estate and the total estate value exceeds the federal exemption limit, estate taxes could apply. In 2020, that exemption is $13.61 million for individuals and $27.22 million for married couples. Some states also impose estate taxes with lower exemption limits, so state laws matter too. Gift taxes can also come into play. If someone owns a life insurance policy on another person and names a third party as the beneficiary, the IRS might see this as a gift. For example, if a husband buys a policy on his wife's life and names their son as the beneficiary, the death benefit could be considered a taxable gift. The policy owner may need to file a gift tax return and pay taxes if the amount exceeds the federal gift tax exemption. Lastly, if you surrender a policy or withdraw cash value from a permanent life insurance policy before death, any amount above what you paid in premiums might be taxed as income. This is separate from the death benefit but is good to know if you're considering cashing out. Knowing these rules helps you plan better. Usually, the death benefit passes directly to your loved ones without taxes, making life insurance a smart way to protect your family's future. Choosing the right payout method and beneficiary can help you avoid unnecessary taxes and maximize the benefit.